Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, May 10th, 2023. So let's just hop right into the charts here, looking at headline inflation. So obviously, the April CPI release is the big the data point of the day. Focusing our economic release spotlight on that. We'll take it right to the chart here. So we're starting with headline CPI that decelerated to 3.2% on a 3-month annualized basis, still north of the pre-COVID trend of 1.7%. So still got some more hay to bale there. Kind of getting there with respect to food inflation. Pretty sharp decline in food inflation over the past kind of couple of quarters. We're now at 1.7% on a 3-month annualized basis. That's a little bit north of its pre-COVID trend. Energy inflation is one of the things that's been most flattering in broader inflation statistics. That decelerated to minus 14.1%, 3-month annualized. That's well below its pre-COVID trend of minus 0.4%. And then it's shifting gears to core inflation. This is where the issues start to come up. And so, as you can see, over the past 3 months, we've seen core inflation 3-month annualized of 5.1% in February, 5% in March, 5% in April. And this is something we've talked about over the past, really since going back to July when we authored the theme. But I think it's becoming increasingly evident in the data, which is that as long as the economy remains resilient, inflation is going to remain resilient. And that's obviously exactly what we're seeing with respect to core inflation. We saw core goods inflation, which is supposed to be in deflation because allegedly there was a mix shift of goods between in consumption from goods to services. But that's obviously not the case because we can see that clearly in the retail sales data, auto sales, core retail sales. That stuff's been growing comfortably above trend in recent months. Core goods CPI accelerated to 3% on a 3-month annualized basis. That's the fastest rate we've seen since going back to since August of last year. That number's well north of its pre-COVID trend. Finally, starting to get some hay bailed on terms of core services CPI. That's it down at 5.7%. 3-month annualized, still more or less double its pre-COVID trend. Hay's, what's driving the bailing of hay in core services inflation is the deceleration we're seeing in shelters CPI. That's decelerated to 7% on a 3-month annualized basis. That number is going all the way down and will sustainably continue to break down. Or sorry, it's likely to sustainably continue to break down, just given the lags of with respect to owner's equivalent rent relative to observed market prices in housing. But to me, it just as bearish as this number is on the page, is this 4.1% 3-month annualized rate of change of super core inflation. That's core services, services, less shelter, less energy, less housing and energy, and that's how we get to our super core metric that Powell's been citing at recent FOMC events. This number's at 4.1%. It's more or less double its pre-COVID trend. That 4.1% is pretty much right in line where it was, kind of the end of last year, beginning of this year. So, this is something we continue to call out as, hey, look, if the Fed is unsuccessful at perpetuating a recession, we're going to keep inflation very handedly well north of that 2% price stability mandate. And as long as the Fed maintains that 2% price stability mandate, we are not out of the woods as it relates to the phase one liquidity cycle downturn. Obviously, we got Janet Yellen coming back to the market with net Treasury issuance on the other side of the pending debt ceiling compromise. And the Treasury Borrowing Advisory Committee recommended that she blast T-bills through the system to sort of help sterilize that pending TGA rebuild. If we're talking about super core inflation at 3.5% to 4% in 2 to 3 months, I don't think she's going to acquiesce to those recommendations. I think what's more likely to happen, with her being a central banker, former head of the Fed, it's very likely that she kind of, gives them the Heisman, stiff arms that recommendation, and ultimately gives the market the coupons that it does not want as it relates to making quantitative tightening a little bit more onerous than it has been in recent months. So this is something that we continue to call out. Obviously, balance sheet policy is the number one driver of monetary policy here in the U.S. currently, but we may actually, a couple of months, if core inflation still bouncing around between 4.5%, 5%, super core inflation bouncing around between 3.5%, 4%, we may actually start to see a return of rate hikes, particularly if the labor market remains resilient in that time frame, which is very much likely to be resilient in that time frame, given the expected timing on a recession based on our business cycle dating models. So transitioning to my loan bow dashboard, we'll start with global macro. One thing we'll call out is the VIX, with a 15 handle on it in terms of the lower boundary of the probable range. This is something we continue to call out. As long as we are not, within striking distance, call it 1 to 3 months of that phase two credit cycle downturn, i.e. that recession process, then it's very unlikely that asset markets are going to move to price in that outcome. And so will you continue to see a volatility compression in the context of a resilient U.S. economy and high nominal growth? that's something that you can very much continue to see. Doesn't necessarily mean recipes, NASDAQ, et cetera, is going to run up and start to make a series of higher highs and higher lows relative to where we've been over the past 6 months. But it certainly means that you could easily continue to see something that looks like frustrated bears out there sitting out there on Twitter who have no idea when the recession's likely to hit. So they put the trade on way too soon. And then lastly, with respect to our KISS portfolio construction exposures, there's nothing particularly overbought or oversold. Got a nearing overbought signal in DXJ. That's the Japan. That's been trading quite well on a currency adjusted basis. It's currency adjusted Japanese equities over the for the past 6 months or so. So with that, Darius Dale wrapping up our macro minute for Wednesday, May 10th, 2023. We got our friend Michael Guide over at Lee Lag Report joining us for Macro Bundle Live today. So looking forward to that. Definitely check us out and subscribe or upgrade if you want to be able to participate. Cheers.